What's up, everybody? Welcome to episode number 91 here on season number 2. And today we are getting into rising interest rates and bonds. This question comes from Carl Sobrado. Though, anyways, I'm sorry I botched the last name. Hopefully I got the first name right. He asks/says, been watching you since I got into Stash. I have a different strategy, but it's always cool to learn what others are doing. Question: what effect will rising Fed rates have on ETFs like Park My Cash? These videos are meant for educational purposes only and not meant to be taken as financial advice. You are responsible for your assets and to properly protect them. So always do your own research. Real quickly, I just want to say thank you, Carl, for watching the channel. I hope that it has brought you some value or at least been entertaining to some degree. And you know what? It's always cool to hear about people's strategies. I know that mine's probably not the perfect one, but it's just a strategy. I think what's more important is that people have a plan on how they're going to invest, because when you don't have a plan, that's when you typically fell in the market. First of all, I just wanted to cover what is a bond. A bond is basically a company offers a note and says, hey, you know what, you can buy this note from us for this much money. You give them the money and then we'll pay you back your money plus some interest. So for instance, if it was like an $1,000 note, you would buy the note from the company, giving them $1,000. They would say, hey, you know what, we're going to give you 5% interest back on that over the next 10 years. So at the end of 10 years, you should have like $1,500 or whatever you'll get paid back in the bond. So you'll get paid back that $1,000 plus that 5% interest over the next 10 years. If you're wondering what Fed rates will do to those bonds, so say you bought a loan at $1,000 at 5% interest. At that time, up until the Fed rates till the interest rates either go up or down, that bond is going to be worth $1,000, unless of course you get paid 8%, and then it will start to drop as you get paid out on that loan. You could go sell that loan the next day for $1,000 to someone else because it's the same rate across the board. Next thing you know, they raise the interest rates up to 7%. That bond, that $1,000 bond, is now worth less because that $1,000 at 7% interest is obviously going to get you your portfolio a lot more value, and so that's going to decrease the amount that you're going to pay for that 5% bond at $1,000. What happens is when interest rates rise, bonds go down because there's higher interest rates on the new bonds. As interest rates go down, bonds price go up because now the bond that you bought at $1,000 at 5% is a premium because, hey, everything else is $1,000 at 3%. So that would be how bond rates or interest rates affect bonds. More specifically, how would it affect a ETF like Park My Cash or most of the Stash ETFs that are going to be the conservative bond type ETFs? It's not really going to affect them as much because those are going to be short-term bonds, which means that they're going to expire pretty soon comparatively to the long-term bonds. And the long-term bonds are obviously going to be more volatile because the interest rate and how much they're worth is going to be completely different than something that might end, a short-term bond that might end in a couple weeks or so. So that's going to be the difference between the short-term versus long-term. A long-term bond is going to be a lot more volatile compared to where a short-term is going to be very, very steady because it's going to mature here soon. To sum it all up again, when interest rates rise, bond prices will drop, and when interest rates drop, bond prices will rise. And that's obviously there's going to be an influx because the math of it, a bond at $1,000 gets 7% compared to 3 years ago a bond at $1,000 gets 5%. Obviously the 7% one is going to have to be worth more than the one that's 5%. And same thing if there was a $1,000 at 3%. They're all going to fluctuate based upon where the interest rate's set at that a specific point in time, but they're going to be priced accordingly as to the interest rate. Go ahead and leave it right there. Let's go ahead and jump into the question of the day, which is, if you wanted to solely drive a roommate insane using only notes, what kind of notes would you leave around the house? I was thinking about this, and one of the notes that I would probably leave is if I was about to go on a vacation and they were at school or at a class or out at their job or something like that, leave a note and be like, hey man, I just did a little bit of cleaning up, took care of some of your stuff. I actually, got rid of it. So don't worry about it. It's not that big of a deal, man. And just leave the note, and they're like, and they come back to the house and like nothing's changed, and they're like, what did he throw away? Like, and start rummaging through stuff. Like, that would be a pretty interesting note to leave behind before you like take off on like a weekend vacation or something. Like I always say, if you have any questions regarding Stash, Acorns, Robinhood, as well as general investing advice, business Etsy coaching, post those questions down below. Don't forget to subscribe up here and check out my Stash recap March edition. Check out that video right here. And as always, thank you for watching. I really appreciate it.